right, everyone. Hello and welcome. Thank you so much for joining us today. Without further ado, it's my pleasure to introduce to you Avi Gilbert. He's the founder of ElliottWaveTrader.net, a live trading room featuring analysis by him and a dynamic community of professional traders. Avi's Elliott Wave analysis appears frequently on sites such as TheStreet.com, MarketWatch, Forbes, and Seeking Alpha. Now, to our live viewers, please type any questions that you may have for Avi into the live chat box. And time permitting, I'll announce those questions at the end of his presentation for him to answer. Now, Avi, with that all said, I'll hand the mic on over to you. So if you need anything, I'll be right here, but the floor's all yours.
Thank you so much, Charlotte, and welcome everybody. We have a lot to cover this evening, and we don't have a lot of time to do it, but the folks at the Money Show said that if we have to go beyond 5 o'clock, they're willing to let me go so I can answer questions. Regarding questions, please wait with questions. Do not ask questions yet. I will likely get to answer most questions in my presentation, so please do not post any questions until we get towards the end and you did not hear me answer your question. The other thing is when you post questions, please keep it on topic. This evening, we are talking about the S&P 500 and a larger degree perspective of the S&P 500. Some of you follow me for gold or bonds or silver or whatever, emerging markets. Please, let's keep all questions on topic. I'm not going to answer any questions off topic this evening, okay? So let's first thing we're going to do is I'm going to give you a quick primer into what Elliott Wave analysis is, and then I'm going to take you to a 100+ year chart of the S&P 500, and then we're going to break it down to smaller time frames to understand where we reside today in the larger degree and then smaller degree structure in the market. So let's start with what is Elliott Wave analysis? Well, back in the 1930s, a gentleman named Ralph Nelson Elliott was very, very curious about why the market crashed and then how it rebounded after that. So he started doing some research and analysis into how the market moves. What he identified was that the market is fractal in nature. What does that mean? Well, it means it's variably self-similar at all different degrees of trend. Well, okay, what does that mean? Well, what he discovered was the market moves in waves. It moves 5 waves in a primary trend and 3 waves in a counter trend. And that breaks down further and further and further. Let me show you on the screen right now, you have 5 waves up. For those that understand Roman numerals, we have Roman numeral 1, 2, 3, 4, 5. 5 waves up, that's a primary trend. Now, if you look at wave 2 and 4, wave 2 and 4 are counter trend movements. They are corrective pullbacks within a 5-wave structure. If you look at waves 1, 3, and 5, they move with the trend. Now, if you look very closely, you'll see that waves 1, 3, and 5 themselves break down into 5-wave structures. And we've outlined that if you just look at wave 3 alone, you'll see wave 3 breaks down into waves 1, 2, 3, 4, 5. And if you would go a degree lower, and let's say you went into wave 1 of wave 3, you would see that also breaks down into 5-wave structures. So when we say the market is variably self-similar at all degrees of trend, it means that it generally maintains this type of structure. There's a certain amount of variability within it, but it generally retains this type of structure. Now, how does the market get to this structure? Well, what Elliott identified was that the market really is tracking the mass sentiment of the entire public. And it is actually the best gauge of mass sentiment across the entire public. And what we've learned many years later is that Fibonacci mathematics regulates these patterns. It regulates the patterns. It tells you how far you're going to go, how far you're going to pull back. It really gives you a certain amount of probability to be able to identify movements within the structure. So that is Elliott Wave analysis in very simplistic terms. So what I'm going to do now is I'm going to show you, hold on. This is our 5-wave structure in a very long-term chart, well over 100 years, as you can see. So if we break it down very simply, okay, right in the middle of the chart, you'll see the top where it says Wall Street crash of 1929. You'll see a Roman numeral 1 at, in parentheses at the top of that, right before the stock market crash of 1929, which lasted approximately 2 years. The crash, as we count it, was a wave 2 in Roman numeral 2 in paren, as you could see on the chart also. Now, if you go all the way up to the right side of the chart, you will see the Roman numeral 3 paren all the way at the top of the chart. Yes, that means that the market has now, or is either has or is very close to completing and a almost 100-year, 90-year wave 3 structure. Now, if I sit back here and I'll tell you that back around 1940 or 1941 or so, Ralph Nelson Elliott himself proclaimed that we are about to see a 70+ year bull market. Now, if you take yourself back to that time frame, what was going on in 1940, 1941? Yes, World War II was raging around us, and America was just about to enter into World War II after the Japanese struck Pearl Harbor. Now imagine you have World War II raging around you. The market had just crashed a few years before. Within a decade before, it had just crashed about 70% during the Wall Street crash of 29. And you're now about 10 years, I'm sorry, about 10, 11 years before. And now you are telling people we're about to enter into a 70+ year bull market. I mean, most people at the time thought Elliott was crazy. We look back at this and we say, you know what? Elliott's call at that time was probably the best market call I've ever seen in my life. And I've gone through much market history. I've not seen a better market call than Elliott's call in 1940, 1941, calling for a 70+ year bull market. And unfortunately, the bad news is we are now at the culmination of that bull market, that big old wave 3. Now, for those of you that can count, what comes after wave 3? Yes, wave 4. And if you remember on that chart I just showed you, a 4th wave is a corrective pullback. It is a counter trend. So before I go into the next level lower, I want you to take a look. If you look at the 2000 tech bubble notation near the top of this chart, you'll see Roman numeral 3. And you'll see a sideways market going from 2000 until 2009, March of 2009 to be specific is when we bottomed. Now, that sideways action was a wave 4 of one lesser degree. It was a 4th wave right before we were working on this final 5th wave to complete this very long-term 3rd wave. Now, I know that the waves within waves is probably one of the most difficult part of Elliott wave analysis for people to grasp. But if you break it down and you track each wave carefully, you'll notice how one wave builds upon another. So I want you to focus on that wave 4 that took us from 2000 to 2009. And then now we are trying to complete this wave 5, which will complete the larger degree Roman numeral 3 in paren, which began after the 29 stock market crash in 1931. So with that being said, let's move into a little more detail as to where we are today. This is that wave 4 that I showed you that was a sideways market. There is your sideways market that we were talking about. Went from 2000 to 2009, and that was a wave 4. And then we had a 5-wave structure to still complete, that larger degree, wave 3 that I showed you off the 1931 low. Now, as you can see from the detail on this monthly chart, we either have completed all 5 waves up, or we have one more higher high. My perspective that I tell all my clients is I am treating this for risk management purposes as though it is completed. However, I will tell you, the structure of this move up did not complete a full 5 waves up, in my opinion. I still think there is a good chance we're going to get a higher high, but I do not have a structure that is developed off this low from October 13th that is telling me that that is a high probability. And because I don't have a structure that developed yet off that low to tell me that it's a high probability that we're going to get that higher high, my advice to our clients, because most of them, 70% of our client base are long-term investors. So for their purposes, I've explained, you should treat this as though the high is in place from a risk management purposes. Now, can we get opportunities that we can see that we can get to higher highs? The answer is yes. Our stock waves team recently put out a list of 22 stocks that have very strong probabilities of getting to higher highs. So if you're looking to ride the market to higher highs, you're best off riding those stocks that have the higher probability of getting there. But for most people looking at this, most people don't want to be sticking around when the game of musical chairs has that last chair being pulled away. And I will tell you, that is looking like where we are headed. Now, if you remember, after a wave 3 completes, so let's say when this wave 3 completes, what happens? We get a wave 4. Now, what's the target for a wave 4? Well, that's the scary part of this. Normally, the standard expectation is that the wave 4 will often target the 4th wave of one lesser degree. And if I mentioned to you before, the 4th wave of one lesser degree was the bottom we struck in March of 2009. And if you remember what that is, yes, that is 666, the devil's number. That is normally a target that we would set for this large degree 4th wave once it begins. Now, there is a secondary target that I'm going to be using as my primary target. And that is when you have an extended 5th wave, the bottom of the 2nd wave of that extended 5th wave is going to be a better target. And that's what I'm using, 1,000. So, between 666 and 1,000, that is generally the target that I'm going to come up with for a very large 4th wave correction. Now, for those of you that think that this is just impossible, I want you to remember back to the 2011 gold market. And anybody that was trading gold at the time, they remember the summer, especially as we moved into the fall for gold, was quite parabolic. There were certain days we'd see $50 rises in gold, and that's when gold hadn't even gone to 2,000 yet. Now, at the time, the argument among the general analyst community was that gold, they were arguing how far beyond gold, 2,000 is gold going to exceed. The argument was not how is gold going to continue. The argument was how far beyond 2,000 was gold going to rally. We looked at it and said, and some of you may have read this article. I wrote this article back in August of 2011. And I said, when gold hits 1915, that is probably going to mark a major top. And we can drop back from that level all the way down to the 700 to 1,000. Now, if you were around at the time and gold was moving parabolically and you were expecting it to go over 2,000, you're looking at, it's going to go back to 1,000. What are you, crazy? Well, As we now know, gold topped within $6 of my target, and then it dropped to a bottom of 1,050 back in late 2015. That same analysis methodology is telling me these are my long-term targets. As crazy as it may sound today, these are my long-term targets. Now, again, I'm still unsure whether the high has been struck yet. From a bottom-up perspective, I don't think it has. From a risk management perspective, I think people should be looking at it as though it has. Now, again, I'm going to give you a little more perspective that is provided for us by this Elliott wave analysis. If you remember the market quote unquote crash during COVID, the COVID crash, and that was this right here. If you remember, most people were going out of their minds during that. And I have to tell you, I was around trading for the bottom in 2000. I traded during 2008 and 2009. And yes, there was a significant amount of fear. I think the fear that we experienced during the COVID crash well eclipsed the fear we experienced back in 2008 and 2009. That's my opinion. And I can tell you that I was probably up 20 hours a day. Some nights I didn't even get to sleep because right now we have over 8,000 members and they were all freaking out. And when I was telling them that as the market was approaching 2,200, I was buying. Why? Well, because the analysis told us that we should be rallying to at least 4,000 from there. I was looking for at least about a double off of there. And why? That's because the structure of the market told us so. Most people thought that was nuts at the time. But I'm telling you things that often will sound nuts up front, but within the benefit of many years of hindsight, you will see these often come to fruition. Again, I'm going to say again, I am not 100% certain if we've hit the high yet. We still have a good chance to go as high as 5,100, 5,200. I'm still not certain of that. But for most people, I think you should be treating a rally as an opportunity to cash in a lot of your long-term profits. That's how I'm treating it. Now, in the meantime, I'll tell you, because Elliott wave analysis is probabilistic by nature, there's no certainty in the market. The market is a non-linear probabilistic environment. There's no certainty. So because there's no certainty, not only do we have a primary view of the market, we also have an alternative view of the market. My alternative view of the market is looking for a 5 to 8 year correction, and that is this 1-2 here. Now, what is that 1-2? Well, assume that this 4, we're assuming that this 4 is going up and completing 5, which ends all of that larger 3. But what if this 4 is only going to start a 5-wave structure that's going to pull back as another 1-2 and then provide us with a massive extended 5th of 3? That is my alternative count. But even that alternative count is probably going to take us back to about the 1775 to 2200 region. That's the good news. The problem is, once we finish this 3-wave pullback here, I'm not going to know whether or not it actually is that alternative count until we see how this rally takes shape. Now, as you can see, you're going to have large drawdowns, and you're also going to have multi-year rallies. It's not going to be a one-way market. You're going to have drawdowns, you're going to have multi-year rallies, but the multi-year rallies will not likely make higher highs. They will make lower highs, as you can see, as we move through it. And just to give you an idea, if you look at this, from the 2002 or so bottom, so from 2003 all the way to 2007, that was a corrective rally. ABC, all sideways. This was a corrective rally. I expect to see multi-year corrective rallies, even if we get the fullness of this 4th wave. So there's going to be investing opportunities for multiple years during that time, but you need to have a much better understanding of the larger degree perspective to know what to do during that time. Not all markets work the same. And in this instance, where everybody understands that, the market bottoms, then it's off to new highs, we've never seen a 20-year bear market. And that is what the larger degree potential would suggest. I would say a minimum of 13 years. Why do I say that? Well, if you note it again, the one smaller degree lower fourth wave, the wave 4 of one lesser degree, is here, one lesser degree. That took 9 years. Well, let's say eight years and change. It took 8 years and change. So I have to expect that a fourth wave of a larger degree is going to take us longer than 8 years. So my expectation is if we get the fullness of this fourth wave, then it's going to take a minimum of 13 years. It could take as long as 20. The smaller degree, 5 to 8 years. That's how I'm looking. Okay, that's how I'm looking at these smaller degrees. Now, on the daily chart, I'll take you in a little bit now. Again, I'm unsure as to whether or not we're going to get that higher high or not. My expectation is I still think we're going to be seeing a pullback over the coming weeks and months. And I think that will probably lead to another rally higher. And then again, this is all probability based, assuming that the market is going to drop in a corrective fashion, wave fashion. Then after the next pullback, I'm going to be looking for another rally. The nature of that rally will likely tell me if we're going to have a higher high or if we are done, top is in place, and that we're only going to top out somewhere between 4,300 to 4,500. And then that's when we see another major market meltdown. And this market meltdown will probably be akin to what we saw during the COVID crash. C waves, let me go back. Corrective structures take ABC structures. They're 3-wave structures. We said impulsive moves that go with the trend are 5-wave structures and break down to 5-wave structures within their 5, and so on and so forth. Waves 1, 3, and 5 are 5-wave structures. Waves 2 and 4 are corrective structures, and waves 2 and 4 break down into 3-wave structures, and we label them ABC. The C wave within a corrective structure is often considered something like a crash structure. It's a crash wave. The C wave is often a crash wave. We saw that with the COVID C wave back in 2020. In fact, at the end of 2019, I said I'm looking for a 30 or 35% move to the downside. The market moved higher on the S&P than I had initially expected, but it clearly gave us our 35% downside. And it was a crash wave. For those of you that were trading in 2010, if you remember the flash crash, that was a C wave. In fact, I came in that day short the market, and I didn't expect we were going to crash that far. My heart was beating out of my chest as I was peeling off my short positions, but that was a crash wave. So if we only get this, then yes, you're going to see a crash, and that potentially could be in late 2023. So I don't think we're going to have a very good idea about whether or not we're going to see a higher high in the market, probably until early 2023. But for most people, I probably would be treating the market rallies as an opportunity to divest, because ultimately we are very much overdue for a very long-term bear market. Okay. I think I'll probably stop here and see if we have questions. Pull up the chat. Okay.
We did get a couple that I've sent over to you just now.
Wave 3 does not often reach 1.0. I really, if it's a 1.0, it's not a wave 3. It's usually a C wave, Adrian. A 1, 2, 3, 6 extension can be a wave 3 in a diagonal structure. That's usually a target for a third wave in a diagonal. The 1, 2, 3, 6 max of 1, 3, and 2. Given you're expecting a probably 75 drop, I'm not expecting a 75 drop in the market, but okay. What alternatives are you suggesting? Ultimately, cash. There are going to be opportunities beyond that, but my view is, and I'm going to post this on the monthly chart again. If you look at this, if you're in cash here and the market drops to here, and then you deploy that cash, you then have an opportunity. You have extra cash now to deploy for a multi-year rally. And then you look to divest again after you get a 3-wave rally right before the next C wave. So ultimately, you will have opportunities to redeploy your money, but for the most part, your cash will become more relatively valuable during a bear market if you can begin to deploy that money near lows. Okay. Saxon, say a major bear word. I've already said this. Metals. I'm going to be doing a metals webinar. I think it's next week, so you may want to register with that with the Money Show. I'm doing a gold review next week. Real estate, all that other stuff likely will get hurt during this next downtrend as well. Are stocks overpriced? I'll tell you this. And it's interesting, your handles Go Bananas. Go Bananas. If you didn't hear my view of the stock market in the bigger picture, and I mean, if you heard my view of the stock market in the bigger picture, and you're still asking me if I view they're overpriced, I'm going to tell you over what time frame. Over what time frame? If you're looking at it from a 50-year time frame, if you're looking at it from a 20-year time frame, you're looking at it from a 5-year time frame. They have different answers, but ultimately, in the bigger picture, yeah, we're overvalued right now, and I'm expecting a bear market to reduce those valuations. What SPX level is your stop on all longs? John, there is no such thing as black and white across the board. I do not believe in black and white. I believe in gray. And when I deal in gray in the market, because I'm dealing with a nonlinear market that has no certainty, I layer in and out when it comes to the market. There's no one point where I'm all in, and there's no one point where I'm all out. For me, it is a layering perspective. Okay, so there's no what is your stop. It depends on what tranche of longs that represents, because I have different tranches with different stop levels. How do we know this is a B wave, bounce, or impulse wave? I don't know what this quote unquote is referring to. Was today a short-term top in SPX? I think we are approaching a short-term top with the SPX. There's still maybe one more 4-5. I'll show you what I'm looking at just so you can see. There we go. I think you're going to get one more 4-5. This form support may be a little higher, but I think you're going to get one more 4-5. This is done. I'm assuming if you're going to see us below, at this point, if we're below 40.40, then you probably are at, you're probably going to be signaling that we are at we've already topped out. We're going to get a nice pullback. I've already discussed it. Dan, wave 5 of 3 does not look right because I cannot count a full mature 5-wave structure. And Larry, this is going to go to your question also about my higher target. If we had gotten the fullness of a full 5-wave structure, as I would standardly see, and I'm going to say standard again, remember, we base everything on probabilities. So from a probabilistic standpoint, the 5,500 to 6,000 region was the ideal target. When we broke down below 4,000, that put that in jeopardy. Remember, we deal in probabilities. There's no such thing as certainty. My target was based upon a probabilistic structure. Just like I told you guys, for those that were following me back in 2020, and I said 2200 was my ideal target for a low for the quote unquote COVID crash. And as we were approaching that, I was layering into longs. Our bottom that we actually struck, I think, was 2187. It was off by 13 points. Perfection in the market is almost impossible. Will I hit my targets to the penny at times? Absolutely. But just like that 2200 target I had on the S&P 500, we missed that by 13 points at that point. When I missed the top in gold, my top was 1915. We topped at 1921. But that's generally hitting the target. In this instance, the 5-wave structure was pointing to 5,500 to 6,000. Unfortunately, when we broke below 4,000, it put that in jeopardy. And I don't foresee us hitting that high at this point in time now. I think if we get a higher high, probably it'll be around 5,150, 5,200, somewhere around there. Any other questions, ladies and gentlemen?
I am waiting to see if one more viewer has a question. We did get another one from Bruno. It may be off topic, though.
I'm not taking off topics.
I thought so.
It's been a long day and it's already past 5 o'clock.
Let's see. Job,
by the
that
way-
sounds more like a comment than a question. He just
Yes.
says we may be an ED from COVID bottom wave 1 and 2 complete.
Okay. I don't see it that way, but okay. If you
Here's a
guys
good
want to learn a little bit more about Elliott wave analysis, feel free to come to our website if you'd like, elliottwavetrader.net. We have tons of information. We have live webinars for beginners 3 times a week. We have a beginner's guide. We teach this stuff from basics all the way to intermediate and advanced. What fib target does wave 5 often reach in a diagonal? Often the 1618 would be minimal. Usually a target's about the 1764. One-day big spikes part of the bear market? Not necessarily. It's all based upon the context. You often see big spikes during the bear market, but anybody remember what happened during April and May of 2020? The market was on a freaking tear. It wasn't part of a bear market. Everybody thought it was a bear market at the time, except for us. It wasn't part of the bear market. Really based upon context. And that's the one thing that Elliott wave gives you, that there's no other analysis that I know of in the world that can provide market context in the manner in which Elliott wave analysis does. That's what allowed us to see the bottom at 2,200 and expectation of 4,400 plus. It's what allowed us to see the top in gold with a pullback that nobody else was expecting. It gives you a framework that can give you a certain amount of context that you can't get anywhere else. If the wave, I'm not getting into the specifics of the smaller time frame, guys. You know, the purpose of this analysis, the purpose of this presentation was to give you the bigger picture and where we are in the larger perspective. I'm not going to go into the smaller things. There's too much complication. Any other questions, ladies and gentlemen, before we call it a day?
Right. I believe I've caught up with all the questions here, at least the ones that are relatively on topic, Avi.
I think that basically covers it then.
All right,
we're good.
perfect. Okay. Avi, thank you so much once again for joining us. It's always such a pleasure to have you present. And
Thank
to
you so
everyone
much for having me.
yes, of course. And everyone in the audience, thank you so much for all your questions. We love seeing the chat light up like that. Be sure to tune in tomorrow at 9:30 a.m. Eastern Standard Time, as we still have a lot more in store for you during this virtual event. All right, I hope everyone has a great rest of your day.